Hey guys, welcome back to another episode of Z Invest. In this video, I'm going to talk to you about two ways to analyze a stock. First, through fundamental analysis, and the second, technical analysis. To keep it plain and simple, fundamental analysis tells you what stocks to buy, and technical analysis tells you when to buy a stock. Now, knowing what to buy and when to buy is really hard to master in real life. No one can predict what will happen to the company in the future or in the near terms, so it is okay for an investor to just stick to knowing what to buy, because knowing when to buy does not really matter that much, because you are going to hold the stocks for a long term anyway. So the short term position should not matter as much as an investor. So in this video, I'm going to talk solely about fundamental analysis and covering what it is about and how do you actually do fundamental analysis. So I hope it can bring some value towards your research. Alright, without further ado, let's jump right into today's content. So there are two types of fundamental analysis. One, the quantitative analysis, and the second, the qualitative analysis. And as the name suggests, quantitative is all about the quantity, the numbers, the raw data that you can find in the annual reports or their financial results. Qualitative, on the other hand, is not about the numbers, are things that cannot be numerized or numberized. So those are things that usually talking about the company's prospect, the future growth, and anything that revolves around that. Alright, let's start with quantitative analysis. The data that I'm going to talk to you about can be found from a company's financial statements, if not from the annual reports. So do not worry, because those are data that generally accessible by the public. So first of all, we look at the raw elements from the financial statements, and usually I take 5 years historicals just to get a better feel of the historical trends. First of all, we look at revenue. Revenue is the top line of a profit and loss statement. Check whether it is in a declining trend or an increasing trend, or it is volatile in nature. Look at the notes and check out whether the components are sustainable or not. Next, you look at the EBITDA. EBITDA is the earnings before interest, tax, depreciation and amortization. So it is a gross profit where you minus off the operating expenses, and it just tells you whether a company is operating efficiently or not. Then we look at the net income or net profit after tax. It is usually the last line of a P&L statement, and it just tells you whether the company's business is profitable or not. Alright, moving on, we look at the balance sheet, and this is where you look at the assets, shareholders' equity, and also the liabilities. So know that asset equals to shareholders' equity plus the total liability. So know that if a company is investing or divesting its business, it can actually be reflected in the amount of assets and liabilities. So for example, if the company is acquiring new plants, new equipments, or just hiring more staffs, they essentially have more assets, and with more assets, company usually finance it with debt. So the number of assets and liabilities are usually correlated, and they will increase simultaneously. You can also look into the notes to the assets, and it's a good place for you to check whether the company is investing in the business or divesting its business, which is a key indicator as to the company's direction as well. And another line that I love the most is the cash and cash equivalents. This is a measure of the company's cold hard cash, and it is usually a good indicator if the company has a huge amount of cash in their disposal. Whether or not the amount is high enough really depends, and is very relative to the amount of debt or short-term borrowings. So keep that in mind as well. Next, we move on to the cash flow statement, and I usually just look at the cash flow generated from operating activities. So this line is a measure of how the company is using their cold hard cash in their business activities. So a positive cash flow from operating activities just tells you that the company is generally profiting from their business. Alright, so once you have extracted all the raw elements from the financial statements, then you are ready for the next step, which is to calculate the financial ratios. So the financial ratios are generally grouped into 5 main groups. So the first group is the liquidity ratios, where it measures a company's ability to meet the short and also long-term obligations and borrowings. Then we have the leverage ratios, which is the measure of a company's relative amount of assets which are provided from their debts. Thirdly, we have the efficiency ratio, which is a measure of company's operating efficiency. Number 4, we have the profitability ratios, which is a measure of a company's ability to generate income from its revenue and also its balance sheets and etc. And number 5, we have the market value ratios, which is the ratios that actually measures whether a company is undervalued or actually overvalued. And for the sake of this video, I'm going to elaborate more on the market value ratios, which I believe is the reason why you are watching this video. You want to know how to analyze a stock and understand whether a stock is actually undervalued or overvalued based on the market value ratios. So in general, there are 5 popular market value ratios that are widely used by investors for fundamental analysis. First of all, we have earnings per share or EPS with a formula of total net income divided by its outstanding shares. The EPS is an indicator of a company's profitability, and a general uptrend signals a buy recommendation. Next up, we have the book value per share, which is the total shareholders' equity divided by its outstanding shares. So in general, if the book value per share is below the market price, it just means that the company is undervalued, and vice versa, it will be overvalued. The third one will be price to earnings ratio, or we call it the PE ratio. So PE ratio is calculated by using its share price divided by its earning per share. And generally, PE ratio ranges around 10 to 15 to 20. So it varies according to industry. So it is best for you to compare with the peer in the same industry. Number 4, we have the price to cash flow ratio, which is the share price divided by its operating cash flow per share. It measures how much a company is able to generate cash flow from its share price. So usually the lower it is, the better it is, because it just means that the company is actually undervalued. And lastly, we have the dividend yield ratio, which is the total dividends paid for the trailing 12 months divided by its share price. This gives you a measure of the return investment when you invest into this company. Okay, that wraps up the quantitative analysis, and I hope I did not get too technical in that sense. I will be developing a Excel spreadsheet that calculates all the financial ratios, and I hope to share with you in the near future. Next up, we look at the qualitative analysis, and this is where things get more interesting. And as the name implies, qualitative analysis is a measure of a stock's or a company's quality. So there is no way to actually measure them in values or numbers. So it is very perspective based. So in general, we look at 4 factors in a qualitative analysis. First of all, you want to understand the business model of the company. What is the core strategy of a company in achieving their profitability? Are they generating positive cash flows year by year? Is their company really profitable? Is their company really protected against technological disruption? Say, look at Astro in Malaysia, for example. We all know that Astro is actually on a declining trend. It has lesser and lesser subscriptions, all thanks to the Android TV box. So if a company's business model is being challenged, then the fundamentals of the company is questionable in this sense. Next up, we look at the competitive advantages of the company, or Warren Buffett likes to call it the economic moat. Do the companies have an edge over their competitors? What is their customer brand worthiness? Do customers usually prefer them over their competitors? Look at the local telco companies, for example. We have Maxis, we have DG, we have Celcom, we have U-Mobile. Let me ask you the question, who has a larger subscriber and why? I believe you know the answer to this question. So that explains to you why the fundamentals of the company is strong, because they have a stronger advantage over their competitors. Also, we can look at the oil and gas industry. We know that the renewable energy industry is the future prospect. So if a RE industry is able to come up with a cheaper solution compared to fossil fuels company, then the fundamentals or the economic moat of a oil and gas industry is no longer valid. Number 3, we look at the company's management or leadership. Does the CEO have a great vision for the company? Is the CEO envisioning greater growth or having greater projects in future? Is the management or the leaderships involved in some sort of corruption or any political issues? Those are the pain points that you'll need to identify, because a management is essentially the front line of any companies. Lastly, we look at other factors which are the hardest to identify, which is political risk and also commercial risk. In terms of political risk, what if there is a change in the ruling government, or what is the impact to the company if there is a change in the government regulations? For example, extra gaming taxes on gaming companies such as. And so yeah, just keep that in mind. Are the companies exposed to high forex movements? Or is there a supply chain disruption due to the US-China trade war? So those are the factors that you need to identify as well. So alright, I've come to the end of this video, and let me just summarize what I've said in the past few minutes. So there are two types of fundamental analysis: quantitative analysis and also qualitative analysis. In quantitative, you look at the numbers, you extract them from annual reports, and you just make the company ratios to measure whether they are undervalued or overvalued. In terms of qualitative analysis, you can just read them from news, from articles, from forums, or just news apps which can give you a general idea of where the company is positioned in. And so those are the analysis that I've conducted when I want to buy a stocks for a long haul. So do not worry, you can get away by just picking a few of the points that I've mentioned in this video. You do not need to check every single box, because more often there is no stock that actually ticks all the boxes, and if they actually do, they're actually one of the most expensive stocks in the stock exchange. And just get yourself invested, because it is better to have more time invested in the market than being out of the market. Trust me, you will learn much more faster if you have your money invested in the market. I hope you have gained some value from this video, and if you do, consider helping me by clicking the like button and also hitting the subscribe button down below. It really just helps me so much in growing my YouTube channel. Always remember to conduct your own research before you make any investing decisions. Do not follow a person's advice blindly, including mine. Alright, thank you very much, and I wish you safe investing. And with that said, I hope to see you in the next one.